So if you're not familiar with the sheet, it's pretty comprehensive. What you do is you go through thank you Ashley for the thumbs up. You go through the intake sheet, which is the first tab on the bottom, and you fill out all information regarding your finances. So the really great thing about this sheet is that it helps you put everything that you could possibly think of in regards to your financial situation in one place. So every time you sit down to do your budget, whether it's every other week or every week, you have all the information in one place. You're not trying to remember where everything is. You don't have to do it by hand, which is really great. And it's really just an opportunity for you to streamline your entire budget setting and maintaining process. So I'm just going to go through this right now. You can fill in your own sheet along the way, but we're just going to put in some numbers here so that way you can see how the rest of the sheet interacts with the intake tab on the bottom left. So I'm just going to go ahead and put my name here. I'm going to put Joe's name there. And we're going to see how my name populates here and his name populates there. So for income, this is basically pertaining to my income. So if you are single, you're really only going to have one part that you need to pay attention to. If you're married, then you're going to pay attention to both parts of the income. So the really cool thing about this is that if you are paid on an hourly rate, you can put that information here. So I'm just going to come up with some numbers right now. So $15 an hour at, let's say, a full work week of 40 hours a week. You can see that automatically calculates my equivalent of an annual salary of $31,200. Say my husband works a flat salary amount of $60,000 a year, then it automatically totals what both salaries are or both incomes are for the entire year. So it gives you your total household income. If you are someone that has a side hustle that you make money off of, feel free to use the extra cells here. So that way you can figure out your total annual income if you need to. Down here, when you scroll down, you're going to see the tax information. So the really cool thing about this part of the sheet is that all you need to do is put an X next to whatever situation pertains to your tax situation. So if you're single, you put an X here. If you're married, filing jointly, you put an X here. If you don't know what one of these items are in terms of taxes, chances are it doesn't pertain to you. So that really answers a lot of questions for people as well. So you notice I only put an X here. And then going to go down to the taxes tab, which is the third tab from the left.
I have a question.
Yes.
Ashley, I cannot find the tool in my email.
Okay, I can email it to you.
Okay, I'm just
I'll have to email it to you after, okay?
Okay, it's just under, like, just setting tool?
I believe the email subject is download your free budget setting tool or something like that.
Thank you. Yes, thanks.
No problem, no problem. If you can't find it still, go ahead and text me afterwards and I'll send you an updated one, okay? So going back to here, as you can see, when you click on the taxes tab, it'll automatically highlight the tax bracket that you put an X next to on the intake sheet. So just to show you what that looks like, if I wanted to take the X out here and say I'm married or single, you can then see that it highlights this tax bracket and it automatically calculates your respective monthly taxes. So let me go back and fix this real quick. Now, one thing that I wanted to mention is that this is based off of the 2020 tax brackets, okay? And each year this is going to change. So just make sure that when it comes to the new year, you download the updated budget setting tool so that way you have an updated tax bracket system on the sheet. Another thing that I wanted to mention is that there are so many different aspects that go into paying your taxes or filing for taxes. So this here is not the end all be all, okay? This is strictly for budget setting purposes. So you can properly estimate your gross income versus the income that's actually going to be hitting your checking account. So you can disperse that net income, your after-tax income, across the rest of your expenses accordingly. So again, this is an estimate. Take it with a grain of salt. You're going to see that it's $970 based off of the income of $91,200 for married filing jointly. So I'm going to take that number and I'm going to put it right here. If you notice when you're looking at your pay stubs that more taxes are coming out each month, update that number so you have a more accurate tax estimate for the rest of your budgeting. So I noticed that, for example, if I have $970 is what I should be paying, but I'm really paying, a little bit more than that, maybe about 15% more than that, I'll put in equals the number that it's estimated to be times, which is the shift 8, 1.15 if it's 15% more, and I just click enter, and it automatically will update within that formula my updated tax estimate there. I'm going to go ahead and go back to the original. Now, if you live in a state that has state income tax, sorry about that, you want to make sure that you put your average in this bracket right here. So it's not in here at all for the, sorry, I keep getting requests to join. So the state income taxes is not on the sheet as of right now because pretty much all except I believe 7 states have state income tax, and they all do it differently. So that's something I'm working on if you do live in a state that has state income tax. But for now, take an average of the past 4 paychecks and then put that number in here so that way you can make sure that you are taking that into account as well. Does anybody have any questions so far on income and taxes? Could be anything. Okay. So we're moving on to the next portion. I like to dictate or define my budget into 2 main categories, the mandatory and the extras. The mandatory is income, taxes, any living expenses, and debt payments. Those are the main 4 pieces that I define as the mandatory aspect. Any money that's left over after paying those items is called the extras or the discretionary income. And how you allocate your discretionary income is entirely up to you. So let's take it piece by piece. The living expenses. Everyone's going to have some type of living expenses unless you have the luxury of living at home rent free, which is great. If you do have that opportunity right now, take advantage of it and save as much as you possibly can. So if you live in a townhome and you're renting it out, you're going to want to put your rent there. If you pay renter's insurance, go ahead and add that in. I have examples on the right-hand side. So if you're unsure if something's supposed to be in the living expenses versus debt payment portion, you have examples here. The reason why I separate living expenses and debt payments is because later on in the sheet, I have a really cool calculator that shows you how you can keep track of your debt payments, how long you have until you can pay them off. And I also have a way that you can expedite your debt payoff process so you can become debt-free sooner. So I'm going to add a few items here for example purposes only. Go ahead, I'm going to give everyone a couple minutes to add some items of their own on their sheets if they haven't already, so you can catch up with me and not feel like you have to do it all on your own. So go ahead, put a few items here, and then put the monthly payment amount on the right-hand side as well.
Quick question. So say for things like your 401k pre-tax deductions that come out of your paycheck, would you include these in your living expense? So like 401k, medical insurance, things like that?
So insurance, like health insurance and dental insurance, I would definitely put in the living expenses portion. Things like 401k, where if you needed to stop your contributions and it wouldn't necessarily affect your day-to-day life, I actually put that as part of your discretionary income. Because, so for example, right now, right, I'll use myself as an example. I lost my mainstream of income as of Friday, and that means that that decreases my total household income by about 25%. So starting this past Monday, I'm not contributing as much to my Roth IRA at this point in time as I normally would be able to or want to be able to. Why? Because it's not necessarily mandatory for me at this point in time. However, I'm still contributing what I can. And I know that once I'm back up to my normal income, I'm going to be contributing into my retirement savings a little bit more. I just don't have the luxury of doing it at this time. However, mandatory, I still need to eat. I still need to pay for gas. I still need to pay for insurance in case something happens. So I, I personally put my retirement savings in my discretionary income. However, if you want to put it in your living expenses portion, you're more than welcome to do so. Just know that when you go to calculate your emergency fund later on in the sheet down here, which I'll give you a quick little look at that right here, whatever amount that you put for your 401k and the living expenses on a monthly basis will be added into that emergency fund calculation later on. Does that make sense?
Yep.
Okay. So totally your discretion. Good question, by the way. I don't get that one often. I like that one.
Thank you.
All right. So I think that everyone has had a moment to fill this out a little bit more. I'm going to scroll down to the debt portion. So I don't know if y'all can see my screen. Is my screen too small, by the way? Do I need to zoom in at all? No? Okay. If at one point you need me to zoom in, please let me know, because what I see and what other people see can be totally different. So examples of debts can be a car loan, student loans, credit card bills, anything that has a debt amount that is carried over. So I oftentimes get the question, well, I have a credit card and it has $2,000 on it, but I'm paying it off at the end of the month. If it's not a balance that you carry over, it doesn't need to be included. So for example, I like to use a credit card for everything. Number one, because I like the points. And number two, if I get some type of fraud on it, I'm much more likely to get my money back than if I were to use a debit card. So I use a credit card for everything. We swipe, 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 but then at the end of the month, we pay it off in full. So when I sit down and do my budget, I don't put my Chase credit card as a debt line item, because it's not a line item that's carried over that I'm trying to consistently pay off to get to that zero line. So if you have a question on that, let me know. For now, go ahead and put whatever debt payments you have. And then in the next column, you're going to put the total amount outstanding. And I'll show you why that's important later on. And your monthly payment amount. You can put your monthly due date if you want. I noticed that adding this column for some of my clients that have a lot of debt items, it helps them keep track of their payments when they're due. It allows them to see if they have a lot of things coming out on the 15th of the month, and they would rather disperse it towards the beginning or end of the month instead, so that way it lines up better with their paychecks and when they need to buy groceries and things like that. So you can put the monthly due date in if you want. If you don't see the need to, that's totally fine as well. I'm going to give everyone a couple more minutes on this, and if anyone has questions, please let me know. All right, we're gonna move on. So donations and gifts. This is the first part of discretionary income. So if you are someone that likes to donate to charity often, or someone that is part of a large family and you need to make an effort to budget properly for gifts or birthday parties, go ahead and add that in here. This is the first part of the discretionary income, and you'll notice that we're not putting any payment amounts, any monthly allocation in the discretionary income parts, because we are going to set that dollar amount once we see everything all together on the budget template tab. So go ahead and just add anything that you have in here. Add a couple charities, birthday gifts, because I'm one of 6. I definitely have to budget for birthday gifts.
Did you let Evan in?
I did. Sorry. Other expenses. So these are things that you like to do, but again, if your living situation or your income situation changes, you could live without if you had to, right? We could all do without going to Starbucks. We can all do without going to the movies or going bowling, right? But we can't do without buying groceries or buying gas. So the other expenses go here. So I'm going to add a few. The examples on the right are just basic examples. If you have something else that you think should go here, go ahead and add it. This is not, you know, a strict key by any means. I'm going to give a couple people that just joined a couple minutes to kind of catch up to where we are. If anyone has questions, feel free to interject. All right, so we are now starting the goals information part of a budget. So we did the mandatory part, the living and the debt payments, and now we did the extras. Now is where you take it a step further and you really put your budget into use. The best way that you can put your budget into use is, number one, maintaining it every month, making sure that you're actually sticking to it properly. And number two, planning and saving for goals that you have. So Alex, you talked about retirement. That's awesome. I talked with someone the other day about planning to go on a vacation, but the vacation was going to be about $5,000. A lot of people don't have that money that they can just pull out of their savings account. So how are you able to do these things? Well, you have to budget for them. You have to make an effort to make a specific line item for it in your budget. And that way, at the end of each month, you're able to hit that mark. And when you hit that mark, you will eventually see it come to fruition. Alex, I know you mentioned earlier about saving for a 401k. So we're talking about an emergency fund now. And an emergency fund, for those of you that don't know, I am a prime example of it right now. Examples are the best way to really understand a concept, but an emergency fund is really like a savings account or a savings bucket that you have a multiple of 3 to 9 months worth of your living and debt expenses. So everything from groceries and rent to making sure you have your student loan payment, your car loan payment, all of the things that you have to pay, right? Dining out, you don't have to pay. Entertainment, you could stop doing that. Buying clothes, you don't need to buy clothes if something were to happen. So what am I doing during this time where I don't have an income? Well, first, I reworked my budget where in our household, we figured out, okay, what are some mandatory expenses that we have to keep up with during this month or two that I won't have an income? And secondly, we figured out how much we are going to have to pull from the emergency fund that we've set up over the past couple years to sustain a standard of living. So we have been working on our emergency fund for a couple years now, honestly. And we've noticed that as we have moved or jobs have changed and our expenses has changed, the amount of emergency fund that we need will rise and fall. So this is not something that, you know, you set today and you need to have tomorrow, right? Oftentimes this number is a fairly large number. It's normally in the fives to tens of thousands for some people. But it's a goal to work towards. And it's a line item that you need to add into your budget to save for each and every month. So the next question that I always get is, okay, so I understand what an emergency fund is, but how many months do I need? 3, 6, 9? Where do I lie? That's completely up to you and your comfortability with the risk, right? So Joe and I have set up an emergency fund for, I think, about 4.5 to 5 months worth of our living expenses. We landed on that number because we figured if both of us were to lose our job, we could sustain all of our expenses and debt payments for 4.5 to 5 months without finding a job. However, in my line of work and in his line of work, it shouldn't take us longer than 5 months to find a new role and to have a new income stream coming in. So 3 months is, a great place to start, right? Put 3 months in if you need to, so that way you have a goal to put in mind. 9 months are for people that are really, really conservative. I normally only suggest 9 months worth of expenses for families that have children, and not just one child, but maybe 2, 3, 4 kids, because oftentimes they'll find that their living expenses and debt expenses, that having an emergency fund just to cover that doesn't just do it. With kids, you have unforeseen expenses come up. What if your kid falls off a trampoline and you need to take them to the emergency room and the bill is $2,500? Your insurance doesn't cover it. You need to have that money somewhere. So for most of you that I see on the call right now, where you're, recently graduated or you're a smaller family, you don't need to have that 9 months unless you would feel comfortable with it. So I'm going to show you how this part works. You just put any number in here, 3 to 9 of months, and it'll automatically calculate based off of the information that you put up at the top of the sheet for living expenses and debt payments, how much you should have saved. So I'm going to put 6 here so you can see how it increases. And then I'm going to put 9 here. A lot of you may be feeling uncomfortable with $20,000 worth of savings, and that's okay. Just know that the best thing you can do is pick a place to start. So put 3 months in for now. If that's uncomfortable for you, put 1 month in. That's okay. Pick a place to start and do it. Because now more than ever, we are seeing the importance of having an emergency fund set up, because a lot of people that thought that their job was so secure, myself included, are coming to realize it's not so secure and you need a backup plan. And oftentimes it's just finding that small little piece that you can bite off and start with. Enough with the scariness and everything. We're gonna move on to something more exciting. So vacations. Our generation loves to take vacations. We like to be spontaneous with our vacations, and that's great. What's not great is swiping your credit card, going on the vacation, having a great time, and then coming back and immediately starting to worry about how you're going to pay for that vacation. That's not relaxing. That's counterintuitive to why you went on the vacation in the first place. So last week when I had this webinar, I had someone ask me, okay, well, what if I want to take a spontaneous vacation? Make it part of your budget every month to save a specific dollar amount towards vacations. Open up a separate savings account if you have to. As long as you are putting that money in there, and if you randomly wanted to go to New York and you knew a trip to New York was going to cost you $500, and you look in your bank account and you have that $500, use it. Be spontaneous and use it. Just don't go into debt for it. That's the whole point of this. So if you know of any vacations that you would like to take after quarantine is over, go ahead and add them. Since I talked about New York, I'll add that here. I know it's not $500. I'll put 2,000 for now. And if you have a specific date that you know you want to go on a vacation, put that date in there so you can work backwards to see, okay, if I'm going to take that vacation by the end of the year, that means I need to save X amount of dollars every month to make sure that I have that set aside by the time I go on that vacation. If it's just a place that you eventually want to go, but you're not sure when, you're just going to go when you have the money saved, leave the date open-ended. You don't have to put a date there. It's really just if you need to work backwards, that's an opportunity for you there. All right, so retirement savings. This is a pretty lengthy topic. And honestly, sitting here and talking about it for about 5 minutes is not going to do you or it justice. So when it comes to figuring out how much you want saved, there are many ways to figure out how much you should have saved, but I want to take the rationale off the board for just a minute. And I want you to think of a number you think you would need for retirement. So go ahead, think of that number. And then think of a number that you would love to have saved. You don't think is possible, but you're thinking, man, it would be awesome if I had this amount saved. Now I want you to multiply that number by 50%. Or add an additional 50%, I should say, to it. That's the number I want you to put on your sheet. It's out of the box. It's irrational. Who cares? Put the number down and figure out how to save for it as you go along. If that is a number that would be really, really awesome to have saved, make it a goal for yourself. That's okay. And if you're not currently saving for retirement, start saving for retirement. I will leave you with some piece of rational advice, I promise, for retirement savings. A good rule of thumb is 10% of your income. So gross income, not net. That is a good number to work towards. If you are not currently saving 10% of your income for retirement, or you can't save 10% of your income for retirement, start small. Start with $50, start with $25, start with $150. Whatever you can start with each month, do it. Because the biggest part when it comes to saving for retirement is really twofold. Number one, you need to get in the habit of saving for retirement, and you need to become comfortable with not having that money in your pocket if you currently are not saving for retirement. You almost need to make yourself think that it's a mandatory expense. That's how you get that discipline behind it. The second thing is, most of you, actually all of you, are very, very young. The $50 that you put in each month right now will compound significantly by the time you retire. Significantly. If you haven't seen my video on retirement savings yet, I have a really great example of, if you were 25 and started saving for retirement versus 45 and started saving for retirement, what your retirement value would be at 65 years old. If you haven't seen that video yet, I highly suggest watching it because it puts a lot of things into perspective. But start with your number, okay? Get comfortable with it. If you get a pay increase, put the entire pay increase into retirement savings. You are able to live off of whatever salary it is that you're currently living off of, so it's no skin off your back, right? Work towards that 10%. Make it a goal for you. Once you hit the 10%, save more if you can and want to. I know that retirement is a huge topic. I'm going to be providing some interview-based videos coming up in the next starting in 2 weeks and then going for about 6 weeks. And my goal is to bring in experts in their particular fields that can speak to these particular topics on a much deeper level than I can. So I have some real estate people coming in, investment people coming in, business owners. My goal is to bring in a financial advisor that can talk about retirement specifically. So if that is something that is of interest to you and there's a particular topic that you want to learn more about, let me know. Please put it in the chat, message me, let me know, because I would love to bring in an expert that you want to hear from. I'm going to go ahead and take a drink of water. Okay. So the final piece of setting your budget is planning for your other goals. So we talked about vacations, we talked about retirement, we talked about emergency fund. But what about the one-off, infrequent, very large, very expensive purchases, like buying a new car, buying a new TV, new laptop, saving for education? Those are hefty goals. And in order to meet them, you need to plan for them. So I'm going to put a couple here. I'm going to talk briefly on this. I have a whole video on this as well that dives deeper into how to save for these, how to prioritize them, all of that. But to give you a little bit of a nugget of information. So say you have a car purchase in mind and you want to buy it and it's going to cost sticker price is going to be $35,000, right? Oftentimes with these larger purchases like cars and homes and things like that, you're not paying for it up front all the time, right? Most people leverage some type of loan, or they only put a particular or smaller down payment on it, so that way they don't have to save for it forever and then pay for it in cash. There's a whole finance concept around this called opportunity cost of capital, right? So I could go deep into this topic for hours. It's probably one of my favorite topics of finance. But just to give you a brief overview of it, it basically states, if it's going to take you 35 years to save for a $35,000 car, and that allows you to pay for it in cash, but the 35 years that you were saving for this car, you ended up having to put, $20,000 into your old car to make sure that it still ran. That doesn't really make a lot of sense if that older car was only worth a couple $1,000s, right? So opportunity cost of capital basically states, figure out the best way for you to get a lower interest rate so you can have a higher return on your capital in a different area. I know I'm probably not doing this topic justice, so I'm going to make a video on it alone. But in other words, if you know that you can put $10,000 down payment down on a car and get a $25,000 loan, and that gets you 3% interest rate, right? But $8,000 as a down payment gets you 6% interest rate. It makes a lot more sense to save that extra $2,000 for the 3% interest rate. So when you put your cost here, don't put the $35,000 sticker price, right? Put the down payment that you would like to have saved. So I'm just going to use this example of $10,000 here. Laptop, you can get a store credit card. If they're doing one of those 0% interest rate things, it might be worth it. I would read the fine print to make sure it's actually 0% interest rate, but most of the time we buy these items in cash. So go ahead, add a few of your goals here, ones that you're gonna have coming up in a year, maybe 2 years from now. Don't think just this year. All right, so we have the whole sheet filled out, the intake sheet. The next part is looking at the budget template. So this is taking all the information from the intake sheet and putting it into a monthly overview. So your income, earnings before taxes, your gross income, your taxes, your net income, all of the living expenses and debt payments that you put, brings you to your bottom line of your discretionary income. This discretionary income is also shown up here. So that way, when you are going through the extras of your budget, right? We only put the title of the item. We didn't put the dollar amount yet. When you put the dollar amount on the sheet here, you're able to see if you actually have that money to spend. Why did I set up the sheet like this? Well, because if you have been spending, let's just say, $5,000 a month on dining out, you can see that you're blowing through your budget, right? It goes to negative $735 left over. But let's just say you're doing $3,000 a month on dining out, but you have all these other items that you want to be spending money on each month, but you only have $1,200 left over to do it. $1,200, let's just say, is not, for example purposes, is not going to cut it for the remainder of the, 8 items left over. It brings things into perspective for you. So as you go through your discretionary income, pay attention to how much money you have left over in this cell here. And think to yourself, okay, is that realistic for the rest of the items that I have? Is that what I want to have left over? Sometimes you're going to see that you might have to shave a little fat off of things that you like spending money on, but don't necessarily need to, right? Now, I'm also not saying completely deny yourself of things that you enjoy. I'm not saying go from $3,000 or even $300 for dining out to zero. That's not realistic either. Instead, set a smaller budget and use it as a reward system for yourself, positive reinforcement for yourself for doing a good job and sticking to your budget. If you find that you're currently spending $300 a month on dining out and you're thinking about going to $0, I highly encourage you to maybe think a little differently about it, right? Okay, I'm going to treat myself to one dinner out every Friday night at $20, right? Put a budget of $80 for dining out. Oh, but I also want to treat myself to Starbucks twice a month. Starbucks should really be called $5, okay? So 5 times 2 drinks, that's $10 right there. Make your dining out budget $90 a month. Think through it a little bit. I'm not saying you have to go all out, but I see with a lot of my clients that try to completely restrict themselves on things that they normally enjoy doing. I give it normally about 2 weeks before they crack. And by crack, I mean, they're doing so good, but man, they really want that McDonald's cheeseburger. They really want it. But no, they set a $0 budget. About 2 weeks in, they crack. They go get that McDonald's cheeseburger. Rather than congratulating themselves on going 2 months without buying that cheeseburger, they then think, oh my God, I just blew my budget. How could I? I'm just, I already messed it up. I'm going to mess it up even more. It doesn't matter anymore, right? They binge into it. They feel guilty about it. So then that $1 cheeseburger from McDonald's turns into every day the rest of that week, maybe they go to McDonald's and they really blow out their budget. So give yourself some restrictions, but don't make your restrictions so tight to where you feel like you're not living a life anymore. That's not what a budget is, okay? So go ahead, fill in your numbers here. And if anyone has any questions, please let me know. Okay. So we already went through the taxes tab. Now we're going to look at the debts. So if you remember on the intake sheet, I'm going to scroll back down to it. When you put your debt information in, you put the total amount outstanding and you put your monthly payment there. Why do I have those two pieces of information? Well, when you go to the debt tab, it shows you based off of the total amount outstanding and the monthly payment, how many months you have left until you've paid that debt off in full. Seeing these numbers in this way really helps you get excited about that number dwindling down. It shows you how you can expedite your payoffs. It really does a lot psychologically more than we think. This right here is the key component on how you can expedite your debt payoff. So say, I forgot what I put on my sheet. All right, so $350, right? Say on my discretionary income from my budget template tab, I wanted to set aside an additional $50 each month to tack on to my debt payments to kind of help pay them off a little bit faster. Right now we're at 57 months until we pay off the car loan. If I change this to $400 of a payment, we're now down to 50 months. So you can play with this number to see if you have a specific date of when you want this paid off, what your monthly payment should be. Now, I talk about expediting your debt payoff. How do you do that? The first one is always a little tough because you feel like you're chugging along, you're not making any progress, but you're not realizing that you're setting the foundation for your progress. So once this car loan is paid off, that $350, you're going to take that $350 payment and you're going to tack it on top of the $150 student loan payment. So rather than $150, you're going to be paying $500 each month. So that $500 each month will then help it pay off even faster. If you have more debt, you take that total $500 and you put that $500 in addition to whatever your other monthly payment is. And you'll notice that as you move down the line, how quickly you pay them off gets faster and faster and faster. It's like a snowball effect, which is why it's called debt snowballing or debt stacking. This is actually how my husband and I have paid off all of our debt except for our mortgage. Mortgage is a little bit of a different story. I feel like mortgages is one of the two main debts that you can have that doesn't necessarily affect you too much. But I mean, we were deep in debt when we first got married, and we used this method to pay off everything in full. Now, I'm not going to sit here and say we paid it off in 2 months. Absolutely not. It wasn't until about 3 weeks ago that we made our final debt payment, our final one. It was 2 years of doing this, but we paid off, I think, 6 different loans off the top of my head in 2 years. So think about that and think about how you can apply this in your life and how that will change your financial future. The next question I always get is, okay, well, I have 5 debts. Which one should I start with? I normally like to look at interest rates, see which of your debts has the highest interest rate and start there. So if I have that extra $50 a month from my discretionary income, I'll take that extra $50 and tack it on to the debt payment with the highest interest rate. If you have 2 loans that are equal interest rates, I would say go with the smaller of the 2 loans, because psychologically when you pay something off, it makes you feel more accomplished. I have a whole video on this coming out, I believe, next week or the following week that really dives deep into this topic. So if you have questions on this, You can ask me in advance to the video. That's totally fine. I don't mind setting up a Zoom call with you and going over it with you one-on-one if that's what you would prefer. But it's really such a fun and liberating process of your budgeting. And lastly, so we talked about setting major goals, right? Vacations, buying a new car, laptop, or retirement savings. So here is kind of the reverse of saving for or paying off your debt payments. You are saving for a larger purchase. So here is the $2,000 for the New York trip that I put on the intake sheet. Here, I didn't put a total for my retirement savings, but whatever number you put, that should populate right here. Car, I said I needed $10,000, and laptop, I said I needed $1,500. So each month when you sit down to do your budget, actually, I need to add something to it, but I'll add it in a second. Each time when you sit down to do your budget, update how much you already have saved. So you sit down the first month and you have zero, right? You can leave it as zero. But the next month you sit down and you've already saved $500, right? Keep updating this every time you update the rest of your budget, so that way you can see your progress towards your goal. So the thing I wanted to mention over here, I forgot to add over here. So say I'm going to save $50 a month, okay? This tells me how many months and years until I can pay it off or till I can buy it, right? But if I think 3 years is too long, I can change that to $250, right? Whatever I have. And it'll then show me a year. Well, say I got a birthday present, really generous, and someone gave me $1,000. Okay, that means I can go on the trip in 4 months based off of the additional $250 monthly savings set aside. So I know I've talked a lot about doing your budget each month, right? Maintaining your budget. Yesterday's video showed you how you can take this budget template sheet, this budget setting tool, and how you can use it to sit down each month and maintain your budget. So if you haven't watched that video yet, I highly suggest watching it. It's about 9.5 minutes long. I share my screen with you for a good half of it, so that way you can see the method to the madness. So if you have questions after watching that video, let me know. But that's what I mean when I say sit down and do your budget. Now, this is pretty much all that I have for you guys today. I know that we started a little bit late because of the technical difficulties we had in the beginning. So I'm going to open it up for about 10 minutes or so worth of questions. So does anybody have any questions? Looks like most of you are on mute. So make sure you unmute yourself if you have any questions.
For housing down payments, what's the good rule of thumb for how much you should have saved? I've heard the conventional 20%. I've also heard that you can get in lower if you have a higher monthly payment.
So I actually used to work in the mortgage industry, so I know enough to be dangerous about the different loan programs. If you are a first-time home buyer, you actually qualify for an FHA loan, which means that you could put down 3.5% of the purchase price. Now, oftentimes you'll hear people say, well, do 20% for the conventional loan. Conventional meaning Fannie or Freddie, right? Fannie Mae, Freddie Mac. They say 20% because then you are not held liable for PMI. Do you know what PMI is?
Yeah, the private mortgage insurance.
Yes. So what a lot of people don't know, though, is that you can put a lower than 20% down payment and avoid the PMI by just paying a lump sum PMI up front. So when Joe and I bought our townhome in Tampa, we did a Fannie Mae loan, so a conventional loan, but we did the minimum down payment, which was 5%. 5% meaning, we did not automatically cover the PMI, right? But we didn't want to be held liable for a higher monthly payment, a monthly mortgage payment. So what we did was we took about, I think it was like $1,500 more to pay the lump sum, and that took off our PMI for the life of the loan. So that's something that you can consider. Another thing with PMI, and I see that someone doesn't know what PMI is, so I'll go ahead and answer that in a second. Another cool thing with PMI that a lot of people don't tell you is that if you do a lower than 20% down payment, right? So 5, 10, 15, whatever your percent down payment is, your PMI will automatically drop off once you hit 78% loan to value, right? So the equivalent of if you had put a 22% down payment, right? Well, why do they do 22% and not 20%? Well, because the mortgage industry likes to make sure that they cover their butts. If you want to have an appraisal done, though, maybe a year or two in, because you did some renovations and you think that you've automatically put equity into the house based off of your renovations, or you think that because the market went up, your value of your home went up, and now your 5% down payment is worth 20% of a down payment, you can have an appraisal done, and that will have them take the PMI off early as well. Did that make sense? Is that a little too fast?
No, that was good. I guess my question is, when negotiating, say, the opportunity to put a PMI up front in a lump sum, is that something you would have a conversation with, say, like a lender?
Correct. So you would have that conversation with specifically your loan officer. So the salesperson that's working on your loan for your mortgage. Oftentimes you'll when you go through the mortgage process, and if you want, we can have a whole conversation on how mortgages work after this, Alex. You're going to have a lot of conversations with your loan officer and with your processor. Your processor will ask you for your documents, your pay stubs, your bank statements, all of that stuff, but they can't make any loan decisions for you or give you any loan advice. So you're going to want to talk to your loan originator, loan officer, whatever you want to call them.
Hey, thank you. That would be great.
No problem. Now, kind of backing it up a little bit. So someone doesn't know what PMI is. Totally fine. PMI is, let me think how to explain this. So when you have your mortgage, your monthly payment includes 4 different pieces. Your principal, so a portion of the actual value of the house, like the purchase price, right? Your interest, your taxes, your property taxes, and your homeowner's insurance. The taxes and insurance is if you escrow. Escrow is a savings bucket that the mortgage company will collect each month, the monthly amount of your equivalent of your annual taxes and homeowner's insurance. So they'll take, for 12 months, they'll take the smaller monthly payment. And then when you have to pay your property taxes or your homeowner's insurance, the mortgage company pays it on your behalf because you've been paying them the monthly payment in escrow. So where does PMI fit in this? So PMI is an additional interest rate tacked on top of these 4 items of your monthly mortgage amount due to a higher level of risk that the mortgage company sees you as a lender holding. Now, why would they consider you being more risky than others? Well, if you're putting a lower down payment on a house, so the magic number for Fannie Mae and Freddie Mac, which is the most common conventional mortgages, you probably hear a lot about it in the news. They like a 20% down payment. Why? Because that lowers your monthly mortgage payment, which means it lowers your debt to income ratio on a monthly basis. It looks better. They have more of your money up front, so they're not as worried about you later on down the road. So 20%, is the number that they've come up with. Any number less than 20%, they automatically deem as extra risky. So they have this thing called PMI, which is an additional interest rate tacked on top to make sure that if you were to default on your loan, they got more money out of you to cover their costs and expenses. I hope that made sense. If it doesn't, please let me know and I can answer it in another way. thank you guys so much for joining me. And I hope you stay safe, stay sick free, and have a great rest of your week. Bye, everybody.